What's up, everyone? Welcome back to the Mortgage Heroes Weekly Podcast. I'm Andy.
I'm Brian.
And I'm Will.
And this week, we're going to talk about predictions and some explanations. I feel like we have some explaining to do. Actually, no. I don't feel like we have the explaining. I feel like the housing market and the economy have some explaining to do.
Hey, Lucy.
I know, right? It's like a straight up I Love Lucy episode up in here. You have some explaining to do. Something's not adding up.
What shows that?
Okay. Back in the old days when it was black and white television, what's black and white? So, welcome guys back to a brand new show. Look, it is predictions and explanations week because there's like some predictions on the horizon, what we think is going to happen. We're already seeing some shifting sand in the marketplace like we have been, but we have some explanations to give. And it's really the market that has some explanations to give because all these competing forces aren't going to prevail. Some are going to prevail over others, and some just aren't really making sense to old Andy over here still. Even though, I mean, they make sense. They're just kind of, I think, defying logic is actually the better way to describe it. Is that a
Very true.
fair statement?
So true.
Is that adequate for you guys too? Does that kind of feel like the same thing?
I'm thinking one thing and the market's thinking another, or does another completely.
It's doing another completely? Yeah. Well, let's get it right into it today, guys. This is actually, the first one is from you, Brian, from Keeping Current Matters about student loans. So don't let student loans hold you back from home ownership. I love the title already. Again, this is on that optimistic slant where a lot of times it's the headlines just trying to get your attention, to get you to, go along with whatever they're about to tell you. But this is one of those optimistic kind of positive pieces where it's like, hey, listen, you can still do that. Here's the data that supports that people in your same situation are already doing that. And I think this is a good one to kick us off with today.
Yeah, so true.
I think this is one of those, obstacles you put in front of yourself whenever you're buying a house. You're like, oh, I can't buy because, I have all this debt. But what I've come to realize is that a lot of these buyers don't understand how the debt is actually looked at by the bank. And one of the things that I encourage people to do is, don't assume you can't buy when you probably can. And what I mean here is that just because you have student loans, it doesn't mean that you're disqualified right off the bat. The lender takes a look at your full financial picture and not just your debts when they're looking to approve you for a mortgage. So this matters because people may self-disqualify themselves before they even get in the fight. So before you even run into that obstacle, make sure you sit down with the professional, have them read your debts, and ask them how the bank looks at those when they're qualifying your debt-to-income ratio for an approval. And what we've come to realize is that, there is the right plan for the right person if you're going about it the right way. And Will, I know you brought up a calculation of how they actually look into the debt. So I'm not too good with my numbers. So I wanted to see.
Me neither. But like. I'm glad that you brought this article. I just didn't know 72% of people think that that's going to delay. People who have student loan debts. I just didn't realize that.
Yeah, that's a pretty high percentage,
that's
isn't it?
That's very high percentage. Obviously you get out of high school, you get out of college, and you're thinking, I have this student loan debt, so I got to pay this off. Because that is a myth. And traditionally speaking, most parents actually teach you that. Yeah, mijo, if you can't afford it, don't, you shouldn't be buying. If you can't buy it cash, don't buy it, right? Which is just leave it alone. But 72%, that's pretty wild.
That's pretty high. And I guess I'm also not like too surprised by that but the counter is that 32% of first-time home buyers had student loans. And so the contrary is that even though people may think that, like it's delaying their ability to buy a house, okay, that might actually be mathematically true too when it comes to applying. But then still 32% of the first-time home buyers, that was last year, had student loans. Yeah. So it's not that it's impossible. It's just another type of debt. Some people got really high car payments too. Yeah. $1,000, $1,500. And, that could even just be for like a newer SUV. I'm not talking about some sort of crazy sports car or something like that. But
yeah. And again, it's lack of knowledge, right? You don't know what you don't know. So and I'm glad that we're doing this because when it comes to VA, they have a formula how to calculate the actual debt on your student loan if it's not reflected on the credit report, right? So if the credit report shows like you got a $20,000 debt, and the credit report shows no payment, a lot of times they're actually in forbearance because they're using their GI Bill, so they're going to school, so that's not covered. But what people don't know is that you actually get $20,000 and you multiply that by 5%, okay? And then you divide that by 12, and average that's around $83 if my calculations are right, more or less. So your monthly debt for that $20,000 is only $83, which is not too bad.
Right, an equivalent monthly payment value.
Correct.
Yeah.
And then with FHA, they have it at 0.5%. And then that's it. So 20,000 times 0.5%, that is what they calculate.
Yeah.
You know, and same as with Freddie Mac, Fannie Mae, it's 1%.
Yeah. So if you're watching this and you're wondering, oh, I have a student loan, can I qualify? Yes, there's a formula depending on the loan type that will help us generate what monthly payment we have to hit you with as part of your debt to loan, as part of your debt to income ratio, as the expected monthly student loan payment. So even though you may not be making the payment now, they have to assume that if you're getting a 30-year loan from them, at some point in the lifespan of that loan, you're going to end up making a payment, and they need to know what they think you're going to end up paying, so they can wager their basically measure their risk in that.
Thank you for bringing that up. Well, it sounds like you should be focusing not on the amount of debt you hold, but rather what your debt to income ratio is looking like at the end of the day once you're paying those debts monthly.
And also, I think it wasn't covered in here, but I know there's probably a big contingency of people who were told in 2024, hey, your student loans are going to be paid off. Yeah. And then now in 2025 with the new administration, they're being told, sorry, your student loan payments are back on. So if you are on the fence on that and you're wondering, am I or am I not, you can still go through the calculation with the guys and figure out, even if you are going to have to make the payment back, what's that monthly equivalent so that you can figure out if it helps your qualification or if it hurts you.
Exactly. And here's another thing that people don't know, but we have an IDR, which is, an interest-driven, income-driven ratio. So we're going to figure that out as to what's your income look like. So if you do have $80,000, $100,000 worth of student loan debt, it's going to depend on your income. A lot of these, college graduates, they're actually going and working at Starbucks still because they're probably going to go after a PhD or what have you. And so, there's a way to calculate that formula and you qualify for that. So I've seen it where a person has a $60,000 worth of debt and they only calculate to be $169. That is the dollar amount that we'll use towards the debt to income ratio, which is great. So you got to look at the credit report. You got to see and ask that person if they applied for the IDR.
Yeah.
So just to clarify, so even if your debt is lower through the calculations, you have to go with what the payment if you're on a plan. So the individual plan. So let's say your income-driven plan is higher than if you would do the calculation. Which one would you go based off?
So when you qualify for that, you're going to use the lower one.
Okay.
So a lot of times if you're earning 50, 60,000, then you'll qualify for that.
Okay.
And so therefore, if your payment right now originally is like $800, they'll reduce that, which is pretty awesome.
Nice. Yeah.
And I've seen that happen quite a bit.
Yeah, that's good to know. And
really
again, that's one of those like lesser known things, but it's just it's part of the process. And we've talked about this a lot this year, which is, look, if you're not even starting the process, you really don't know. You're flying blind and you're competing upstream against people who are prepared and ready, and they're already got their finger on the trigger. So if you find yourself in that position where you do still have student loan debt, you are trying to buy a house and you're not sure, you are actually at step one. That step one is have the conversation, figure it out, do the calculations, and then you know what you got to work on, if anything, or if you can start pounding the pavement and start hunting down a house.
Yeah, the other thing, guys, is there's also a debt forgiveness. I know this new administration is actually pretty strict with that, but we saw back in the years when the Biden administration was around, it looks right here that they approved over $183 billion in debt forgiveness in student loans. So you never know. Go see if they're still around.
Yeah, I know. Put yourself up. Maybe not this year, but in 4 years.
And I believe one of them, an acquaintance. I don't have to say the last name, but Mr. Charles, he had over $150,000, Brian, worth of student loan debt. Get it? He's about my age, so that's a long time ago that he actually graduated, and they carry on this debt. Because a lot of times, depending on their income, they'll just do a forbearance. Hey, I can't pay right now, so forbearance, or they'll sell out the loans and try to refinance it into something else with another student loan, which is also very common. Fast forward into, I want to say this was about a year and a half ago, maybe even 2. That debt was forgiven, $150,000.
Jesus Christ!
All of it.
Yeah.
And the qualification was you were either a teacher in the education field. There was a couple requirements, more than 10 years, and then that would just be gone.
Mm-hmm. Yeah.
So
yeah, if you met those certain variables, they're like, done, no payment. So
it's crazy.
I think the takeaway here for me is really 2. Number 1, you can buy a house if you have a student loan, and number 2, you don't have to wait. So find out right now. If you don't know, then you need to find out.
Yeah.
All right. Next one, guys, here we have housing market forecast for 2025, housing market prediction. So this is more the prediction part of today's show broadly, which is, look, we've had climbing house prices for years. We have elevated mortgage rates that are kind of being sticky. So it's been a while now that we've had prices where they're at. Now, the change has been that there's more inventory in the market, but that inventory isn't crushing prices. Now, there have been several articles and a couple other news outlets that have tried to suggest that there's impending doom and that there's a crisis at hand, but we don't see the crisis yet because everyone that is in a house that is selling, they have lots of equity still. So, when I kind of think about this, they use the term here, hopeful home buyers. And I like that term because I think that's also our student loan people we just talked about in the last segment. They're hopeful home buyers. And even folks that don't have student loans that want to buy a house, they can still be a hopeful home buyer. It's just about the qualification part and economically figuring out where are you in the mix of all the things that are happening with prices holding where they're at, inventory on the rise, and mortgage rates kind of flat, if you will.
So you mentioned that inventory is up, so roughly about 30% year over year. And one of the things that I would encourage that I feel this is a great opportunity for is use that increased inventory to your advantage. What I mean by that is shop patiently. If you know that you're going to be buying a house, take this time to make some runway for yourself going into the summer. See what that market is looking like. Get your cuts in, but also be wary that if you're able to move quickly and a deal comes up, be quick on your feet. But also use the time on the market to negotiate better terms. Andy, you said the prices are still sticking. They haven't dropped really pretty much, but use that information. If you know that the prices are staying, houses are on the market for a little bit longer, then maybe try to negotiate a little bit better terms for you. Go for it, ask away. And if you get an answer is no, then hey, that's where the negotiation starts.
Yeah, no, absolutely. I like here where it says that thanks to climbing home prices and higher mortgage rates, it's been a tough few years for housing market. So true, guys.
Yeah.
The great thing about this article is also predicting, like it's giving us we're going in the right direction here. So it's like kind of, and I put it right here, Brian keeps saying this, buyer prepare, right? Buyers got to be prepared. Brian, you've been giving nothing but good information, and you're absolutely right. Gradually, we've been seeing more inventory. So more inventory just gets you to better negotiation terms, And then the other one is affordability remains challenged. It really does with the high interest rates. But the market are also predicting that interest rates should actually be a little more favorable as the year ends, which is great. The other thing is, buyers stay flexible and watch rate trends. That's a recommendation and a takeaway from this article. And the inventory shifts closely when planning to purchase. So just keep your eye on the market. Keep your ear cling to what's happening with interest rate. And I put right there, like I said, Brian keeps saying this, buyers prepare, just be prepared and put yourself in a position to win. Don't wait till the last minute, because once the interest rates start going down, what's going to start happening is there's going to be more people wanting to buy. They're going to get off the sideline and they're just going to rush to it. And then there goes the prices. Because still, even though inventory has increased to, according to Altra's research, to 156,000 homes available, that what's going to happen is when the rates go down, you're going to start seeing deterioration on that. There's just going to be more people, hey, I could afford this. I might as well take it now. And, now just know that the interest rate is something I'm going to be able to refinance down the line.
Yeah, the price is the price you get once. The rate's something you can adjust along the way if you have to. It's about getting in if you can. And I want to remind everyone, every seller's situation is different. You're going to find some sellers that are a little bit more desperate because of their life need, their financial need, or whatever. And you're not going to necessarily that's not necessarily going to be disclosed to you. But tuck that in your back pocket. Remember that when you're going in and you're trying to make a bid, you're working on closing cost scenarios, or you're working on trying to get some concessions or something like that. Just remember, there's going to be sellers, especially in the rising inventory environment, that they have equity, and the decision they're making is just how much less am I willing to take to get this deal off my plate to go solve the other problem I'm having in my life. I got to move because of work, or I'm moving my spouse into a senior home, or I got to pay off all this debt, or whatever it is. Not everybody is going to be able to hold on to the luxury of the golden handcuff, low rate environment that they got when they refinanced in 2020 and 2021. Some people's life situation just isn't going to add up to be able to hold that forever. So in that situation, beware, number one, and then be active and keep your feet moving like a boxer in a ring. Just keep those feet moving, keep those hands up, and then boom, take your shots when you can get them.
I like that, Andy. I mean, homes are predicted to go up maybe 1 to 4% this year, and I think you got to act before prices go up. If you're in the market right now, don't wait too long hoping for a major price reduction. If it makes sense right now, get in, because down the line you'll have opportunities that's going to make your situation better, refinancing or building equity a lot faster.
Yeah. Well, to your point, you're saying that home prices are going to continue to go up. Fannie Mae predicted a 4.1% increase.
Yeah. I
which
had
is
to range
pretty
1.3
crisp.
to 4.1.
Yeah, and then Mortgage Bankers Association 1.3, which is way down. But then you come the National Association of Realtors coming in at 3%.
So what does that tell you? That
three
all
big
of them are
agencies,
positive.
they're all saying positive growth, and even if it's slowing, it's still in the positive direction.
Exactly.
So again, the data in the end is going to show whether or not that prevails or becomes true. But even if the median price goes down a little bit, which it has over the last couple of years, it's got to tick down just a little bit, not numerically super significant that it's hair on fire, everyone run for the hills, but enough to kind of, I guess, get a headline out of it, but nothing more, because really it just comes down to even these variables are saying that all these associations are trying to be predictive that, and it's not because they're trying to sell you on the idea. Everyone's going to go, oh yeah, of course they are. There are housing associations. Okay, sure, fine. But then if they've said that year over year over year, and it's been true year over year over year, at what point are you going to say, well, they're just true still, or they're just trying to sell me into the idea?
Yeah, no, exactly.
By that time, you already bought in.
You know what I'm saying? Like, I'm not trying to diss people. It's just like, at some point, you kind of have to come to qualms with it and go, okay, look, either they are predicting this accurately, even if they're hedging a little bit on the positive side. If it's still neutral even, then that's good. That means you waiting longer to try to get a price that's 5% below market or 10, that may not come around.
Absolutely.
I really feel, I was talking to one of my realtor partners and I asked him, well, what are you seeing out with buyers? What obstacles are they running into, or what are they telling you? And he said, honestly, like they're afraid to get pre-approved because interest rates. And I said, okay. And I feel that it's just more of a personal belief that, hey, I can't get pre-approved, or hey, I don't want to buy right now because of these headlines. And at some point, all these headlines are just diluting what people's decisions are going to be because of the fact that every week something new is coming out. So, hey, if that's you, I say attach yourself to something that, you can get behind and follow that, because in a world where there's so many things coming out at once, well, what can you believe in? Yep. Find something that is, how do I say it, connected to what you are aligned to, and then just stick to that, because there's going to be so much noise, but just focus on what you're able to do in and day out.
Yeah.
No, absolutely. What I got out of this article was I put the pros and cons. Rates may dip. Is that a good thing? Absolutely. That's what we all need.
Yeah.
We need that confidence. And so just hearing that is just giving us a confidence, knowing that inflation is lower, annual inflation is lower this year. The last time we saw this was back in 2022. So this is also great news. The other thing that we're seeing is more inventory. More inventory, like you mentioned earlier, 30% more nationwide. That's a good thing. Yeah. We've been seeing it a lot more here in San Diego. I want to say that, don't quote me, but it was like 65 to 70% more inventory. We're starting to see Texas the same thing. Mm-hmm. They had about 45% more inventory. Las Vegas started having more inventory. Florida, and we can go on, the list goes on. Yeah. But that's a good thing for home buyers. That brings stability to home prices, which is the next one. Slower price of growth, right? Now people don't feel like they're getting bid out.
Yeah.
Otherwise, it's just I'm getting bid out. I go in there and it's like, how do I compete with this when people are putting $50,000, $100,000 more than I can because they sold their house in San Francisco. Now they're coming here, getting a second. They're buying it pretty much outright cash. And then to your point, better negotiation power. Now we can actually negotiate better terms. Can you give me a 2-1 buy down? Yeah. And my rate's going to be 7% right now, which is pretty much the national average, about 7% for conventional. Well, I can start at a 5%.
Yeah.
You can negotiate that. You can have your realtor negotiate that then. And then buy now, refi later. Again, the whole cliche, don't marry the rate. Marry the home. Don't marry the interest rate.
Yeah.
So
this has a lot to do with just trying to hedge the market and time the market. It's not going to be perfect. It's only by looking back in the rearview mirror can you go, oh, the dip was exactly this month in this year. You never know that until you get beyond it far enough to see that on the graph it kind of bottomed out. And there may not be a bottoming out this time, guys. The whole all these comparisons to 2008 and how rampant inflation of home prices went and all this and that. There was financing then that we don't have now. There were conditions then that we don't have now. So the fact that a couple variables look the same doesn't mean that everything under the surface is the same. And that's, I think, making this a little more complicated for people because they're kind of hearing over here like, oh, well, maybe this is going to collapse and crash like everything else, but it's not the same function. It's not the same thing. Yeah. And, you know, you're talking about inventory. You mentioned Texas a minute ago. Like, Texas pulled the most permits back in March. We talked about this a couple weeks ago. Like, 15% of the permits that were filed to build homes came from Texas. Yeah. So out of our 50 states, one state accounted for 15% of new permits, and the state that had the second most permits was 9%. So the two of them together, equivalent is about 25% of all the permits. Two states pulled them. Wow. So there's more inventory coming there. And then mentioned here, the silver tsunami, which I love it. I like brand new terms, right? So the silver tsunami, for those of you.
Baby boomers.
Yeah, these are the baby boomers who are going to end up selling their house because this was a second ago. They either need to, lateral move, go from a 2-story to 1-story. They need to size down maybe, or maybe they're moving it all together and they're going to a senior care or some sort of other living community and they're going to get rid of their house. Well, there can be inventory in there too. So I think that my prediction is, again, end of summer or end of spring into the summer, I think you're going to see a lot more activity. And also the Fed keeping their foot where it is planted, even though I disagree, I think they should drop their rate now. I think that when they finally do drop their rate, that's going to be a signal to everyone else kind of sentiment-wise, it's go time. And I think that is when you're going to see a lot of this extra inventory get absorbed. Rates are going to ease up a little bit, and then we're going to see a more healthy housing rebound.
Absolutely. I agree with you 100%.
And Jerome Powell will be praised.
Yeah, that's it. You're talking about that, which brings me to the next thing with the cons, Andy, and it's still expensive. It's out there. We're still seeing, home prices elevated. The other thing is going to be rates still elevated, but at least we understand that they're going to come down, right? So that's one of the cons with that. Economic risk, inflation, right? We don't know what the tariffs are going to do, so we do run that risk, and that's why I think rates have leveled off where they're at because of that. But once we start seeing that, oh, you know what? We already have agreements out there with other countries, we should be okay. As a matter of fact, you brought up the point earlier this morning about our credit rating. That went down too.
We got degraded.
We went down from AAA to AA1.
Shout out Moody's.
Yeah.
And again, that's all speculation.
Yeah.
It's all based on speculation.
Yes, it's an opinion, number one. It is backed by some variables that they measure in order to apply that rating, just like we do in FICO score. But the other thing is that I'm not sure if it's really a lagging indicator as much as they want to say it is or not, because I think that's just more of a look backwards and blame the other guy kind of thing. But even then, overall, does that hurt us? Look, the issue isn't hurting. The issue is, in my opinion, it's more about how do we get to here now? How do we go from 19 trillion to 38? Exactly. Not how we're going, 38 to 42 is the problem, or 38 to whatever. How do we go from 19 to 38? I mean, I know how. I know the answer. Please don't. I know. If you know, I know. I know the answer. But we doubled our debt in 5 years. That's a big ass problem. And again, I'm not going to backwards blame either, but now isn't the time to cry foul. It was back then. So we're really super late to that party, if you will, and I'm not surprised by the downgrade. I don't think it's long-term going to hurt us because the problem at large is way bigger than just this one rating thing. Any more to add to that?
No, that's so true.
All right. Well, you guys want to continue on? Let's go to the next thing because I want to talk about foreclosures. So foreclosures are interesting because they are still below pre-pandemic levels, even though we have higher interest rates, even though we have higher house prices, even though we've had inflation competing for everyone's dollar every single day of the week, every single where they shop and buy things. Plus, here's the other thing. We've had, and you've said this before, and this is where I agree, we've had much more stringent underwriting standards over the last couple of years than we did in 2008 Absolutely. And 2009. All the stuff prior to that, 100% financing, no money down, conventional, no income, no job, no assets required, credit score only, yeah, that's super risky. That's not what we're in now. That's not the environment. 125% cash out with a HELOC second. No one's doing that. So the foreclosure risk I see now is very much more subject to just the person's economic situation and their finances, not that and the fact that the market is rife with products that are about ticking time bombs.
No, absolutely. But this one kind of puts a little bit of doom and gloom right there, right? But at the same time, it gives us good information where it's actually not so. And the reason why I say that is because what's actually giving the whole doom and gloom is out there in the media. It's saying hey, foreclosure are all-time high. They're coming up, all this is happening. But when you really look at it, and the article actually specifies there that we're still below pre-pandemic, so which is just great. And what's the reasoning behind that? The reason is because we still have people who qualified, with utilizing their income versus back in 2008 and all that stuff, that it was just kind of like you had a heartbeat and a great credit score, you get a loan, you're good. 2 thumbs up.
Yep.
And a house.
Well, and I think in this case too, you have, even though people may have gotten a 3%, 3.5%, 4% on the refinance, like, oh, the interest rate's so terrible now. Well, not to them.
Yeah.
So it's not terrible to them. So as long as their economic situation hasn't changed, they're still able to make that housing payment, which means you're not going to see that foreclosure unless something else happens, unfortunately or unexpected in their life, that they're not financially prepared for. On top of that, you have way more equity now than you did before, because people were getting into the market at the peak of the market at 100%, and then it went down and collapsed because of what was undermining and eroding the financial system as a whole. But now we have so much equity, highest ever on record. Well, that means if you're in a pinch, just sell your place.
That's it.
Oh, and you have to sell your place? Fine, more inventory. Oh, which we have demand for. So guess what? It's all going to work out. I don't think we're going to fall off a cliff and then just hit this ravine down the bottom.
Yeah, that's what I was going to say. I mean, I was not originating back in 2008, 2006, 2007 area. But what I do see now, and I feel that, looking back at history, is that there's more exit strategies nowadays. I mean, I'm not sure how wholesaling, sub-2, and all this other stuff was doing back in the day. But nowadays, there's multiple ways to get out of your property. You could sub-2 it. Someone else could take over your payment. You can, wholesale it. Someone could come in and, still get rid of it if it's in bad condition. So there's multiple ways. And then, Andy, you brought up the point. There's so much equity that, foreclosure is goddamn like probably the last option before you actually get in there, unless you're like in a very financial rut. But then there's still so many safe rails, guards in place that, avoid foreclosure. Like, I feel banks nowadays would rather help the buyer stay in the house because they want to continue, getting that monthly payment rather than going and putting it up on the market and saying, hey, now I'm going to sell this house, take a loss, and then now we all lose.
Yeah,
that's very true. People do have an exit strategy. The main exit strategy right now is that they hold a certain amount of equity where they can utilize that, sell it, pay everything off. I mean, we had a client that was, pretty tight in income. He had a second property, an investment property in Las Vegas. And, his credit actually was going into shambles because he lost his job and he was just struggling. Like, how do I pay that debt off? And so one of our advice is like, sell that Vegas, and we analyze the data, right? What's your payment? What are you collecting in rents after you pay off the property management company? So he was just left over a couple $100.
Yeah. It makes sense.
Is that really worth it? And you have tied up like $60,000 of equity in there. The best thing in that situation, sell it off, pay off that high credit card debt, and then later you're going to rinse and repeat.
Yeah. I look at it kind of like an athlete that gets hurt on the field, and it's like, hey, you might need to take a week or two off, but then by week 3, after you've been injured, you're going to come back and you're going to be strong again. So you might just need to take that temporary pause where, yeah, you might have, hurt yourself a little bit. Okay, but that doesn't mean you lose your position on the team. You still got a primary house or even a primary and a second, and you got to sell your third or fourth, whatever it is. Even if it is your primary, okay, cool. Maybe you got to go down to the minor leagues. You come back up to major leagues again another time, but at least you can leave while wiping out some debt, removing yourself from the threat of foreclosure. And again, and the reason we're so adamant about this is because there have been times in the past where people have called us or told us that their situation was dire too late in the game for us to do anything. So while it's early, if you have a situation that is threatening that you could be facing foreclosure, there are things you can do about it before you get that far down the road, and that's your only option because your silence will not help you in this situation. Speaking up, asking for help, getting clarification is going to be your best friend, and selling might just be the best way out of the situation.
And I think a lot of people are, we see the job labor market at its lowest. Right?
You mean unemployment?
Unemployment is just one of its lowest. I mean, that's great. That's why we haven't seen interest rates, go down also, because that's that has a huge impact as to where interest rates go. The situation here, what's happening is I think a lot of people are going into in certain problems is because now they're coming up with apps where you can finance a burrito, right? You can finance your food. Yeah. All these things where people are seeing is, and we saw this early in Washington, to buy a slice of pizza, it's $8. It went from $2 to $8. Everything is costing more, even though our inflation's down. It seems like inflation hasn't gone down for us consumers. Mm-hmm. But, our government keeps saying, no, everything's consumer confidence is good. It's not.
It's offset. It's one thing that's up by 20%, 20%. Another thing, and then there's one item that's down by 20. That's down by 20. Okay,
it's
so
going down.
it's neutral. Well, no, because you have to look at it like in more specifics, right? And I'm not defending the government. I'm saying that overall inflation can be slower than it was before. It was like at a 9% clip 3 years ago. Now it's like at 2.1 or something like that. Okay, that's better. But we didn't go from like +9 to like -9 to get back to where we started from. We're at +9 to +3, +2, +2. Okay, so we're still up there. We're elevated. But my issue is that you have to, like, it's nuanced. Some things are just more expensive than others when you look at the tail of the tape. And CNBC, I disagree with most times. There's a lot of things that they actually do when it comes to the inflation report where it shows it like industry by industry. That's crazy. Some of them are like 30% up and then some are like 20% down. So when you look at it in the detailed fashion, it actually tells more of the story.
Absolutely. You know, the reason why I bring that up, because it says here on the article, credit data in general doesn't look great when accounting for credit card debt, auto loans, and student loan debt. All have increased in their percentage on 90-day lates. We're all late. Like, these debts are crazy. And so I was looking at what is the national consumer debt right now. We're at 18.04 trillion. Jesus Christ. That is
what?
Yes. Last year we were at 18. We were a little lower than that. And so I wanted to just have a breakdown. So mortgage debt accounts for 12.8 trillion. Which is pretty crazy. And then we got student loan. Get a load of this. 1.63 trillion.
Wow. Dang.
We love giving loans to our kids, right? This is what it's all about. Get these kids in debt at a young age, which is pretty nice. Auto loans were at 1.64. Credit card debt at 1.18 trillion. We're talking trillions. Home equity lines, which is pretty nuts. I thought that would be way up there. Guys, it's only at 402 billion.
Did you just say only 402 billion?
You know, well, in comparison to
I know.
everything else that's not as important, right?
I'm just being nerdy.
Yeah.
Just listening to that gives me chills, because the most, how do I say, the things that you need to survive, you know, the things that you need to excel in life, the things that you use day in and day out. You live in a house, you need education to learn to get higher, further in life, and then you need a car to get anywhere. And those are the things that are, weighing down on you the most, which is the things that you probably, use the most.
I was pretty astonished when I saw the number breakdown.
So what do you guys think as far as your prediction? Do you think we're going to see more foreclosures in 2025, or do you think we're going to see less?
If things go the way they're going right now, Andy, I foresee there's going to be more.
You do? Okay.
Absolutely.
So you don't think people are going to sell and kind of pull the eject button?
I think a lot of people, it's like, and we've been seeing this. I've actually been, we talk with a lot of realtors. We've been seeing a lot of what's called a BPO, a broker price of payment.
Yeah.
That's right before it goes into foreclosure. A lot of people just get that sentimental value where they wait to the last minute until the bank just comes and takes over. We've been saying a lot of that. We've been hearing a lot more low modifications out there. So these are the talks that are happening out there. People are wanting to stay with that lower payment because their money, their job, their income is not producing enough for them to justify them keeping this home and all the other debt.
Yeah. Okay. What do you think?
I think people are going to sell. I
Okay.
think people are going to sell before they foreclose, unless they completely lose their job from one day to another. But even then, you can still just put your house on the market and sell it in 30, 40 days.
Yeah. I think the difference between people selling and people holding on with a grip of life until the very end, it really comes down to just, I don't mean pride in the arrogant way. Just I don't want to admit I'm going to take this loss, Yeah. There are circumstances, of course, where foreclosure is just what's going to happen, and because there's not another way out. And they bought a house in the last couple of years, so maybe there's not as much equity. I think it's just a lot less than it is compared to 2008.
Absolutely.
Like comparing in articles once again. So I don't think that's really I don't think that's a fair enough assessment to the common reader who isn't in these seats on the front lines every day like you guys are.
I think there's so much going on that you can't just generalize it. Somebody could be in a completely different situation.
That's what I'm saying.
Yeah. So it's kind of like, I would say, smart decisions sell. Yeah. But
well, this is what's happening, right? What we're not hearing right now is one thing that we learned with the pandemic is what were we doing for the consumer? Doing loan modifications, and then what will we do with the balance forbearances for 12 months? Then extended 2 years, right? So what happens to that balance that was not paid? It gets refinanced and gets tacked on in a loan modification. What if nowadays the value isn't there because they've already used some of that and now they're experiencing the same situation?
Yeah.
Right? And that's what I'm talking about. Those type of foreclosures that we're gonna start seeing because it's like you don't have much in there already. We already tacked on prior to, and now we're tacking on more.
Those are those same ones I'm saying. Those are the ones that if they did buy during that time and they did that tack on, those are going to be the ones we probably see. It's not going to be the people who got a 40% house price valuation increase and now they didn't touch any of their equity. They have tons of equity they're going to sell. So there's that marginalized, I'll say more marginalized group. You're right. You're 100% right, though. It's going to get paid one way or another.
No, and we're going to start seeing it. Texas, we got with the wholesaler. What are they doing? Loan modifications for a lot of VA. It's happening. I mean, we're seeing it over there. Why in Texas? Home prices have gone down a little bit. They're still kind of there, not gone down drastically, but there's just a lot of inventory out there, right? The other thing that they've been experiencing is higher property taxes. And then insurances are going up. As a matter of fact, California. Insurances on January 1st for California, we've also been experienced quite a bit too. And also has to do a lot with these fires that came. You know, these farmers insurance, they don't have enough.
The bills come due.
Right? They don't have enough to sustain themselves.
I know I didn't bring it up, but I think their 17% increase got approved.
Yeah, it did. It's been all over.
We're going to have to probably talk about that on another one.
Something else.
But that's it, yeah.
But yeah, 17% starting January 1st.
Yeah, these are those all competing factors I was talking about at the top. It's like, hey, something's got to give, right? And ultimately, yes, will there be foreclosures just by default because there will be more? Yes, there will be. Will there be people that can sell so they can get out of it last minute? I think there will be as well.
No, absolutely.
Yeah.
I don't think we're going to see foreclosures like we did in 2008. That's just not going to happen. That history won't happen.
We're not there.
I really hope, though, it doesn't happen.
So let's maybe close out with this one, guys, the mortgage demand. So mortgage demand from homebuyers continues to recover even with higher interest rates. And this is more opinion. And this is, again, the forecast part of me, which is like, I think people are just like, well, whatever, it is what it is. And whatever I got to do to get in, I'm going to do. If we got to get an extra job, if I got to get roommates, I got to qualify with other people with me, buy with my friends, people are just figuring out ways to do it because they're like, you know what, hands up in the air. Well, whatever. It doesn't look the way it did for my parents. I'm not waiting no more. I'm going ahead.
Yeah, I think it's time to understand what the market is doing. Play within the realm of what the market is giving you right now. You can't go off and make your own play right now. You know, look for crazy price reductions, because if that's you, this is definitely not the market for you to buy. Right now, it's for people that you need to buy, that need to step up in bases, that need to downsize, need to pay off debt. It's all transactional purchases that is happening yourself. So I think that, you know, having that information, you can't get too lucky with. I mean, you can't get too comfortable with trying to wait and, you know, seeing that prices are going to come down. But one thing that I do see is that you can't look at buying a house right now like, you know, like you're day trading or like you're swing trading. You can't, you know, time the market perfectly, get in and get out. It's kind of a long-term play. So make sure that you know that going in, because these next 3-4 years are going to be very scrutinized depending on what decision you make today.
Damn. Yeah. Brian, I think they listened to you. I think this article was made because of you. You've been telling buyers, prepare. And that's really what we're seeing right here.
I'm running out of ways to say it.
But it's so true, right? Like, just prepare. And I think that's what's happening with a lot of people is let me just follow Brian's instructions. Let me give all my paperwork. It's not as difficult as people may seem to get fully approved and understand what your current options will be. You know, and if there's certain things we have to work on, if one thing you always say is that we'll create an action plan for you, whether it's going to be repairing your credit, whether it's going to be having to increase your income, or just maybe that's not going to be the purchase price where you're going to be at. I mean, these things, this full transparency that you provide, is just something that people should take advantage of. And now we're going back to an article that pretty much states that, like, here, prepare for yourself, you know. There's nothing wrong with that, and we're starting to see more people going into the trenches and just getting approved.
And there's still options for you. It doesn't hurt, and there's still options for you. I mean, the very top of the show, we were talking about people with student loans buying houses. Okay, so last year, 32% of the people who bought homes had student loans. Yeah. So if you have a student loan, and then this article is referencing that our government loans have had a sharp increase of number of applications. So okay, that's FHA, that's VA, that's USDA. They either have no or low down payment choices. So that typically goes hand in hand with first-time home buyers who have student loans and are still qualifying. Like, this is the play. This is the move. Yeah. If we're not seeing that there's going to be a toppling of prices on the market, then at some point you have to be honest with yourself and look in the mirror and go, when am I going to do this, or am I just not going to do it at all?
Yeah, no, it's wonderful. You know, as a matter of fact, we just got a client approved, and she called me. We approved her back in 2021, didn't pull the trigger and everything. So she just, hey, I already have a home, so I'm not ready. Sends me a text, we're ready. And I'm like, I go in there and you already live in a great area. I live in Bonita. It's a great area. It's a great house. But I feel like, we want to push for something bigger. And I'm like, okay, so what are your plans? Are you going to, sell that property and, and get your VA back? She's like, no, we both have VAs. So I'm like, okay, great. Well, what's your balance on that? Oh, it's like $500,000. What are the rents? I looked at the payment. The payment's like 28 and change because they got a 2.25%, easily rental for $5,500. And I go, why you guys want to just keep that? And they're like, well, yeah, we're thinking to either keep that or you want to take advantage of sell it for $500,000, no capital gains, right? Because she's a married couple, so they can go ahead and have $500,000, no capital gains. She's like, I never knew that.
Oh, geez, what?
And I said, so that's you can go ahead and buy other property, still go at 100% financing, because they told me, yeah, we retired. We both receive VA disability compensation.
Oh my gosh,
so
dude.
we can use one. So now we're putting the whole story together. Long story short, I got them approved for 1.4.5 mil, debt to income, 36 over 41.
What?
Which is still low.
That's super low.
Keeping the property, not having to sell it.
That's
Whoa,
a dangerous.
that's
That's
crazy.
a dangerous buyer's combo right there. Just having that financial profile right there is just.
That's crazy.
I'd be so
and
grateful.
she was so like, whoa, I didn't even think.
Dang.
But here's the sacrifice, right? They've been working hard. They retired from the military after 20 plus years. They got disability. Now they have great jobs, great retirement, disability. So they're now relying on 3 incomes.
Yeah.
Their son's also in the military, PCS to San Diego. So they're thinking, hey, maybe we'll have my son live in this property and we're just renting for what that is.
He's going to get
And we're okay.
BAH. Him and whoever else going to live there can contribute to the payment. That's crazy.
But we also put ourselves in a position where, do you keep that or do you sell and take advantage of that 500,000 capital gains,
Right.
tax-free capital gains? Invest in different investment vehicles where it can give you a greater rate of return instead of that 4% or 1.1%, like they said earlier. Who knows?
That's
Like,
amazing.
what do you do, right? But they're in a good position.
That's a great story, man.
Thank you,
You
for
know?
sharing that. That's freaking awesome. And I think that we share so many, tough, real stories. Like we're talking, yeah, it's hard to buy a house right now. Yeah, it's very expensive. But also in between what we talk about, we share those success stories. We share those strategies. We share that it can be done. We share that people are doing it. And I think that's what we need to focus on. There's so many reasons why you shouldn't do it. But then look at all the success stories of why people are doing it, why they are succeeding. And I think, stories like that are just a testament to why people can buy if they're willing to buy. And if you have the right team, the right information in front of you, then making those tough decisions isn't as hard.
Yeah, that's a great point.
Yeah, I think we're going to see more of this. I mean, just the rate of people that are on social space right now talking about how to use your VA benefit, specifically VA benefit, to your advantage as a buyer who's looking to also create a real estate portfolio of investment properties and how to do that by utilizing your VA. I see a lot more of that now than I did 3 years ago. Way more than 5 years ago, and even way more than that than 8 and 10 years ago. Like, no one was talking about that 10 years ago. I mean, unless you want to check my memory, but back in 2015, I didn't see a lot of dudes on social media talking about how to use your VA benefit to buy a second, third, fourth, or do what you just talked to these clients about. So it is happening a lot more, and people that are in the military that have done this are coming out and getting into lending. They're getting into real estate. They're getting into development. They're getting into investment. And they're leveraging their benefits, no matter what that benefit package looks like. They're leveraging it to do all these things I just mentioned.
Yeah, I mean,
and it's a big tide shift.
Yeah, and I know we're focusing right now on VA, but FHA is the same scenario. FHA, we just closed on another deal, self-employed, and certain restrictions don't apply when it comes to FHA because it's a government loan, especially for investors, not investors. I apologize, self-employed people, right? So they have the tendency of just kind of, I don't want to say bending the guidelines, but they're a lot more lenient because it's got that backing from the government, whereas with conventional, they're just going to really stick with it, and that's what it is.
Yeah, it's a different marketplace.
Very
for sure.
different, but the whole goal with it is, hey, on the next tax returns, just claim more income so we can qualify for conventional. So when we need to refinance, we free out of that. That way we remove the PMI that otherwise they stick with it for 30 years because they only went with 3.5% down.
Yeah.
Those are critical points. If you're self-employed, there's multiple ways to skin the cat.
Absolutely.
Just because you think that you can't get approved, that someone told you I need 2 years tax returns, there's multiple ways. Sit down, have someone understand your financial profile more than anything, because chances are they didn't understand your financial profile when they went to approve you.
I honestly believe that inventory and market conditions are going to draw people in, and we're going to see more mortgage applications come through this spring and summer than maybe we even predicted. I just think that the environment is ripe for that. I think that's just what we're going to see. And it's not just me being optimistic over here in the corner. I see story and story again of people getting creative, people having tenacity, people going, you know what? No, I'm not going to be on the losing side of the coin flip and never be an owner. I'm going to be an owner somehow or another. And that discipline to ask a question, to get qualified, to go hunting, to be patient, to work out a concession deal with the seller, like, look, how many more times do we have to see that before we finally go, you know what? This has changed. Yeah. There's a whole new breed of buyer out there right now, and I think we're inviting more of them in, and I think we're going to see more of that, especially as inventory continues to rise.
Well, the last weeks, we've just been seeing buyer applications increase. It's what it is. I mean, they're listening to Brian. I'm telling you, people are listening to Brian. They're finally saying, it's true. What Brian, the information that he's giving about preparing yourself and getting into the trenches is so true. It's not that complicated. Let's get this thing done. So good job.
When you
keep putting that
You said it earlier in a different way. You're saying people self-select out. It's like they're self-selecting. They're like, oh, I'm going to check myself out of the game. I'm going to go sit on the bench. And the coach is like, no, get in there. You're supposed to, we need you over there.
I'm the coach.
Over there, right? Yeah. So I think there's just some of that where people, your case studies is a good example of this, where it's like people don't think that there's a scenario like theirs that results in them getting keys and having their own house. But there is. And so as you keep seeing this happen, and you have scenarios, and then you have scenarios that people go, oh my gosh, that's my story, or that's similar enough where I have a fighting chance. Wow, I didn't know that. Okay, now I'm in.
Yeah, I'm lucky that you brought in I'm the coach, because right now, kids, you're seeing them grow up. Like when I was raising my older kids, now they're 32, 30, 31. Back in that day, personal coaching just started for kids. And if you weren't choosing to personally coach your kids, like get a personal trainer for them, like these kids are going to be left behind. Yeah. So you got to get the proper guidance. You got to get the proper techniques. You go out there and hopefully you get into that sport that you're getting and you'll understand it and you'll just be a better baller.
Yeah.
And so that's what I feel like you mentioning that. If you don't get the proper coaching or the proper surrounding, you're going to get left out.
Yeah.
And those are just going to be facts. How many people right now wish they had the proper guidance, proper information that they would have probably bought before? Or they would have said, I don't want to buy a condo. I should buy a single family residence because I could afford it, but I thought the payment was going to be lower and da-da-da. So fast forward, it's like, why didn't I do that? Mm-hmm. And I think, Brian, with all this information that you're giving, I'm glad that you keep putting it out there, because I think it's, getting the people attracted to that. Get a freaking approved. It doesn't cost you anything.
I'm very hopeful that it's growing like a bamboo. It's entrenching itself down in the roots so that it could sprout up. And that's what I'm hoping that spring and summer is looking like. Like everybody's just like, waiting for the right time, but at the same time, listening, applying the stuff that they've been waiting and they're learning. And then summer comes around and you have everything that lined up. You have the job, you saved up money, your credit's good, you paid down some debt. Like, what excuse do you have now?
No, and you're absolutely right. So people are going to say, well, it's because you're in the mortgage industry. You need to be saying that. Yes. I'm telling you, because the majority of people, Andy, out of the thousands of people that we've helped, you know how many people have come back and said, I shouldn't have bought?
Well, none.
No. I looked at you. I was like, "Wait,
what are you talking about?"
Are you ready for a real answer?
So
trick question.
We
none?
do. So again, going back to Brian, keep telling people, like, I'm glad that you're saying it that way, because people should just, once you get approved, you make your own decision whether you want to do it or not. But at least now you have the numbers, you have the understanding what that payment looks like. We're giving you the calculators, and if you're not getting the calculators through the person that pre-approves you, please ask them for that.
And that's the other
way
thing.
You understand your scenarios.
That's a really important point, and this is where we gotta kind of put our foot down on some things. Is like, listen, other people might tell you don't do it. Other people might say you shouldn't, and then there's gonna be these guys who are gonna tell you like how you can and how you should, and then you're gonna end up getting the thing you really want. So again, I don't want to just say ignore the naysayers, but you're going to have to ignore some of the naysayers who think you shouldn't, or the timing's better than this. They're going to have their reasons. They're going to have their explanations. And that's fine, but they're probably going to lack the 20 years of experience and the thousands of closings. Yeah. Like, just to be honest, and I don't mean to say that to be arrogant, but they're probably going to lack 20 years of experience and thousands of closings that are going to try to compete for your attention to make you make a decision that may not be in the benefit of the outcome you're looking for.
Andy, what's the current equity percentage that we have right now. Not
do you mean?
percentage, but dollar amount that we have.
It's
the highest.
trillions of dollars. It's like $11 trillion of equity or something
I think
stupid
it was
like
higher
that.
than that, than way higher.
Fine, I'm being
right?
conservative.
I think
Great.
it was like 50
it's in the
trillion
teens.
or whatever.
It's a lot.
Like, there's a reason why we have that much in equity right now. There's a reason. You know, and if you go back even 100 years back and you see what homes were purchased at that point in time in comparison to what you have now, it's longevity in there. So you're not going to go wrong as long as you can still continue to make your payment. And if you lose your job and you can utilize the community, you know, to come in and say, hey, I'm going to rent a room, you know, or I'm going to divide a room and I can now do two. You have to make sacrifices. In the long run, if you're able to sustain that property, your equity is going to increase because we already have the data. For over 100 years, we're already proven that fact.
And I'm going to go back to the coaching thing. You know, some of the best athletes on the entire planet, in the entire history of all sports, have had coaches that tell them the minute little nuanced things you need to change or adjust to take your game to the next level. And because you guys are in that kind of situation, you're not just cheerleaders like, yeah, good, you could do it. Like, no, you're actually showing people, hey, change this, modify that, make this tweak over here, and then it can result in that pathway towards success. I think that's a huge, huge advantage, number one. Number two, I'm going to also say that the number one predictor of generational wealth is home ownership or not. It's not stock holdings or not. It's not passing down wealth or not. It's home ownership or not. So when you look at the, I don't know, last 100, 200, 300 years, you look at generational wealth that does go from one generation to the next, the people who have the most compared to those who have the least or none at all is home ownership. It is the number one predictor of there being the potential of generational wealth because of this equity thing that we're talking about right now. This it's like that crazy friend that shows up to your door with a brand new sports car. Hey, get in, hold on. Like that's the market right now. Get in and hold on.
And that's the thing, right, Brian? We mentioned earlier about the foreclosures. That's why we're not going to see as many because people have a lot of equity. They still have the opportunity, like, hey, if I did lose my job, I can't make my payments, I can go through this and eat up some of my equity for a while longer. It's just you're giving yourself a better opportunity, a better chance of being able to recover. And those are the very important, you know, options to have. When you rent, what options do you have? You can't make your payment, you're out. 30-day eviction.
You got to find another place to live.
You're gone within 30 days. California, unfortunately, you know, hey, you file for bankruptcy, it could go for a couple of years, whatever. But still, that's your only option. There's nothing there that you gained.
Homeownership for the win, guys.
Absolutely. So there you go, man.
What was your favorite part of the show today, Brian?
My favorite part of the show is just driving the point home that you're capable of doing more than you think, but you just have to have the right plan. And I think having the confidence in what you're doing is going to build up a lot more momentum in these next couple of months if you're adequately just, you know, taking the time to understand what decisions you got to make if you want to buy a house. Because I think at the end of the day, it's just fear-based of people not making that decision because of the fear of the unknown. But when you have all the information, you have all the data, you have everything in line that makes sense for your situation, it's really just up to you making that decision.
How about you?
Mine was the article, the housing market forecast for 2025. I just feel like there's a lot more pros that you can have. And the great thing I like about the article, it breaks down a little bit of everything, the economics, the rates, you know, everything that's going to influence the housing market. So I love that, again, the pros outweigh the cons. And that's what I'm all about. As long as we're there and this is what we're doing, that's how I'm building my wealth. That's how I'm teaching my clients that they can build the wealth utilizing their VA, utilizing the low down payment assistance that we have out there or no down payment assistance with grants. There's a lot of options for them to build that generational wealth that we all deserve to be built, especially if you're here and serving our country. By all means, utilize that VA, get it done, and buy wherever you're stationed.
That's a good one. I'm going to go with overall optimism, guys. So first article today, don't let student loans hold you back from home ownership. I agree with that. You know, we've been talking a couple weeks now that we've had mortgage rate articles or mortgage related and real estate related articles that are more on the optimistic side of things. And it's not just the doom and gloom. And it's not just paint the broad stroke of negativity across things. A couple weeks ago, where was it? Episode 112, housing market shows positive sign for summer of 2025. Yeah. Okay, and on that same week, 2 weeks ago, the next article we talked about was homebuyer mortgage demand drops further. Guess what? And I said at that time, wait 2 weeks or 3 weeks. hey, guess what? Mortgage demand on the rebound. Hey.
Yeah.
So
It's so true.
there's more signs looking up and better than there are looking negative and doom and gloom. And for that, I think that is my favorite part of today's episode in general, but prompted by that number one article. So awesome find, Brian. And to all of you who do have student loans and you're looking to buy a house, hey, take a look. Just take a look, deal with the numbers as they are, and play the hand that you are dealt.
That's it.
Yeah, 1 to 2 years of sacrificing, trying to get in your house, staying in your house could put you ahead multiple years.
Yep.
Yeah.
Well, thank you guys for another great show, and thank you all for watching. Remember to like this video, subscribe to the channel, turn on notifications so that every time we drop a new video, you hear about it first. If you are in Chula Vista or San Diego and you recently saw that the Gaylord project just opened on the west side of Chula Vista, be sure to check out our most recent Friends of Mortgage Heroes episode with Mr. Chula Vista himself, Kurt Bunch of the Instagram account Living Chula Vista, the fastest growing Instagram account in all of Chula Vista. That guy was invited to the grand opening.
That was so fun, so much fun.
Shout out,
And
Kurt.
did coverage throughout the whole weekend on Instagram. So if you missed that episode, go back and check out that with Kurt. He is so enthusiastic about the future of our city, and I am here for it.
Yep.
Thank
And
you
I'll be
guys.
there this week.
Yeah, thank you guys for a great show. Thank you all for watching, and we'll see you again next week.
Yeah. If you like this video and like to subscribe, click here. And if you want to watch other videos, click here.